And looking at it from a timeline perspective, today versus yesterday tsaka tomorrow. No, alam niyo naman, today, the present, yesterday is the past, tomorrow is the future. And accounting deals with us being in the present, being today, looking at today, looking in the past, or revisiting what happened yesterday and reporting on it. Yan ang accounting, di ba? Kaya ang term nila, historical approach or historical reporting. Kasi when you say accounting, we account for what has transpired in the past. Risk management, on the other hand, we are in the present and we're trying to prepare what may happen in the future. So, kung i-align mo yan sa IFRS 9, si classification and measurement, somewhere in the middle of yesterday and today. Kasi today, you only have to report what you have captured yesterday. So kung bumili ka ng corporate bonds, i-report mo sa financial statements mo today na may binili kang corporate bonds yesterday, recorded as fair value through other comprehensive income. With fair value changes reported in other comprehensive income section of the equity in balance sheet. Expected credit loss is today, ano ba yung nangyari last time, and then ano rin pwede mangyari in the future, and I record and capture or adjust the allowance for probable losses or bad debts. The third one, hedge accounting, prepares what may happen in the future, and then we take action today. So, si classification and measurement, accounting yan with a, may konting halo ng risk management and strategy. Si expected credit loss is accounting, pero ang totoo, risk management din yan. Kasi bakit ka magpapautang sa alam mong hindi makakabayad? Kung magpautang ka to someone na alam mong hindi magbabayad, automatic loss na yun. So, ganun din si ECN. Si hedge accounting is actually an exception to the classification and measurement rules, which we'll highlight later. And it deals with financial risks and allowing the companies to make financial reporting adjustments to reflect those financial risk management decisions. Let me elaborate in the coming slides. Okay. Again, this is how we depict the balance sheet. Your left-hand side are your your assets, while your right-hand side are your liabilities or debt and equities. Your right-hand side are your sources of funding. Saan ba nanggaling ang pera ng business as at a given point in time? The left-hand side, the assets, are your uses of the funds you've raised. Saan mo ba dineploy yung perang ni-raise mo? Binili mo ba ng assets yan? O ginastos mo ba? Yung ginastos mo, naging receivable ba? Yung receivable mo, nakolekta mo ba? How efficient are you in running the business? So again, when you're asked, is the company growing? Look at the right-hand side, sources of fund. When you're asked, how efficient is management in generating value and achieving its mandate and corporate objectives? Look at the left-hand side, uses of funds. And IFRS 9 classification and measurement. As mentioned, si liabilities, dalawa lang ang category. Amortized cost, which is predominantly the category that you will see in practice, and fair value to profit and loss, which are usually the derivatives that are negative balance, meaning ikaw yung may utang dun sa counterparty mo sa kontrata. Classification and measurement is predominantly for financial assets. Anong categories ba? FVPL ba yan? Fair value through other comprehensive income or amortized cost? And looking at those three categories, no, comparing it to the liability side, medyo straightforward yung liability. Yung asset side, may dalawa kang tanong. Remember, SPPI, tsaka business model test. And when you perform the business model assessment test, yung FVOCI tsaka amortized cost, alam mo, hold yan. No? Hold to collect only or hold to collect and sell. Either way, pag hold, exposed ka sa credit risk. Pero pag may portion na sell, like hold to collect and sell, or hold because I want to sell it at a higher price, exposed ka naman sa market risk. Credit risk is the risk that the counterparty, your debtors, will not be able to fulfill their side of the obligation, meaning they're not able to pay the cash flows, so principal and interest, on time, in full, or at all. Market risk, on the other hand, is the risk that fluctuations in market variables result in fair value or actual losses to the company. An example niyan is, let's say, foreign exchange. Bumili ka ng asset, ng dollar-denominated asset, when the dollar peso was at its height of 58 pesos to a dollar. And then the dollar exchange rate went down, meaning peso strengthened and the dollar weakened. So yung 58 naging 55, naging 54. That 4 peso differential is your fair value loss. That potential for the company to lose money by that amount is market risk. And usually, kahit yung liability side mo, may market risk din dyan. What are the sources of market risk or types of market risk for accounting purposes? Dalawa. The first is the risk that the fair value would change. And I will illustrate later saan nanggagaling yan. The second type is the risk that because of market changes in the future, your cash flows will fluctuate as well. So yan yung two sources of market risk. Change in fair value or change in cash flow. How does it work? Okay. Suppose you have a fixed rate instrument. When you say fixed rate, the coupon interest are fixed in the beginning, and therefore you can already plot with reasonable certainty how much of the cash flows will be received. Let's just say principal is 100% and then coupon is 5% for the next 5 years per annum. So 5, 5, 5, 5, 5 plus 100. Itsura. Floating rate instruments, on the other hand, you have virtually the same maturity date or duration, let's just say 5 years. But rather than fixing the interest rate, the coupon interest rate in the beginning, you allow for some variety through repricing. So pwedeng 5-year loan, pero annually nire-reprice or nire-readjust yung utang. That's floating rate. May mga ganyang instruments for corporates, but probably if you have a mortgage for your house or your condominium, you'll be asked, anong gusto niyo po? 1-year repricing, 2-year repricing, 3-year repricing, or 5 years repricing? And they would vary in interest rate. And every period that you selected, let's say every 2 years ang repricing mo. So every 2 years, nagbabago ang interest rate mo depending on the prevailing interest rate at that time until mag-mature yung loan. So looking at the two cash flow profiles The first one is exposed to fair value risk, while the second one is exposed to cash flow risk. Ito yung dalawang market risk na we have to be concerned about. How does fair value risk work? Remember, the cash flows are fixed, but the interest rate in the market changes over time. So its fair value would change depending on where interest rates are currently. Kung 5% ang coupon rate niyan, and then the market is now at 8%, fair value goes down. If the next reporting period from 8%, naging 4% ang prevailing market rate, magiging fair value gain bigla yan. So, nagpa-fluctuate. Pero yung cash flows mo, fixed, flat. Pag floating rate instrument, baliktad. Yung first portion ang usually kasi na-fix yan at the beginning and then floating na afterwards. Pero yung fair value niya would only be fluctuating in the beginning, yung fixed portion, and then adjusting na over time. That's fine for fair value purposes. But for cash flow purposes, doon ka magkaka-volatility kasi hindi mo naman alam magkano ika-cash out mo or cash in mo if this is an asset because of changes in market variables. So itong dalawang to, fair value risk is for fixed rate instruments or debt instruments. Floating rate, cash flow risk is for floating rate debt instruments. Either way, you'll always be exposed to market risk. Pipili ka lang ng isa, cash flow or fair value. Yan ang exposure mo sa financial instruments mo, particularly sa debt instruments. Now, let's look back at how financial instruments are measured at fair value. It's just keeping things updated. So if an instrument has been if the instrument is a 10-year corporate bond, but it has been issued 5 years ago, then it has still 5 years remaining. But the market factors that were incorporated when preparing and structuring the 10-year bond 5 years ago have already changed. Pwedeng ang inflation nun is 1% or 0.5%. But now, 5 years after, the inflation is 9% or 8%. So the interest rate regime would likewise be different. And that difference leads to fluctuation of fair values for fixed rate securities. There are two main factors for fixed income valuation. Look at the coupon rate or contracted rate, and look at the market rate or the effective interest rate. If both are the same, you would accept the fair value to be at par. If market rate is higher than the coupon rate, then the instrument is said to be at a discount. Bakit at a discount? This instrument only gets me 5%. If I bought a similar instrument from the market, I would have gotten 6% or 100 basis points better or 1% higher. For me to buy your 5% instrument, give me a discount. Kaya discount ang tawag. Suppose that the market rate is 4% lower than the coupon rate, or the coupon rate is higher than the market rate. It is said to be at a premium. Bakit premium? The market is only asking for 4%, but this instrument will earn you 5%. Before I give it to you, give me an additional amount, a premium. So, discount, premium. Ganun lang ang debt instruments, discount or premium. Sir Japs, paano yung mga receivables ko? Wala namang interest rates yun. Then those instruments those fixed income or debt instruments will always have 0% coupon rate. And as long as the market rate remains positive, those instruments would always be at a discount. So kung meron ka receivable, gusto mong ibenta yung receivable mo, merong bibili niyan, bibigyan mo sila ng discount. So when you plot the interest rates and the fair value of a fixed rate debt instrument, ganyan ang itsura niya. Inversely related. The higher the interest rate, the lower the fair value. Kasi when you perform present value computation, the farther you are from maturity date, the higher the interest rate, the lower the resulting fair value right now. We've been talking about interest rates. I'm a certified public accountant, but what I'm about to tell you is about economics. So this is my appreciation of macroeconomics. You can always correct me if you feel that I am wrong. No, but what I'll share is how I appreciated economics of interest rates as it relates to risk management and accounting. So interest rates that you would see in fixed income securities, yung coupon rate, let's say 7%. May components yan. Hindi yan basta-basta 7%. Yung corporate bond na 5 years, bigla na lang 7%. Because 7-year interest rates are 7%. Sure. Pero, mahihimay mo yan. Interest rates are comprised of the risk-free rate or the hurdle rate or the minimum yield that you can get out of from the market without incurring any default risk. That is your risk-free rate. Risk-free siya kasi default risk ang pinag-uusapan. And this interest rate, risk-free rate is usually the government yield, government securities yield. And the reason they're risk-free because the government is the last entity you would expect in a country to default. That's why it's risk-free. But that risk-free rate may breakdown pa yan. Meron kang real interest rate tsaka inflation component. So pansin nyo, inflation will always be there in terms of price accretion, tumataas ang presyo ng bilihin. So yung sweldo natin, kung ang increase ng sweldo natin ay 5%, but the annual inflation is 6%. No, kahit tumaas yung sweldo natin, in reality, yung purchasing power natin bumababa. So kailangan nag-outpace yung salary growth mo or revenue growth mo versus the inflation. And if the inflation rate is still lower compared to the risk-free rate, that means whatever is left is the real interest rate. Yung totoong yield na binibigay or ma-earn mo from the use of the money. Another component of interest rate would be your credit risk premium. Ito yung dinadagdag mo in addition to the risk-free rate to compensate you for the additional risk that the counterparty may default. Between the government and a private institution, mas mataas ang probability that this private institution will default versus the government. Therefore, if you're lending to the entity and the risk-free rate is 4%, ideally, your yield with that private entity must be higher than 4%. And that difference is usually your credit risk premium to compensate you for the risk that the counterparty may end up defaulting versus your minimum or risk-free financial instruments. Another component would be liquidity premium. Liquidity premium relates more to the saleability of the asset. If the asset is liquid or can easily be offloaded or monetized, then the liquidity premium is very thin. However, if the instrument is illiquid or difficult to resell because there's no resale market, you'll ask for additional compensation in the form of higher interest rate. Finally, profit margin, no? Pwedeng hurdle rate or cost of capital mo 6.5%. So you lend out at 7% kasi the 50 basis points difference or 0.5% is your profit margin over your cost of funds or cost of capital. Why are we highlighting this? Because when we talk about financial instruments, specifically debt instruments, the value of which fluctuate depending on where the interest rate levels are, ito yung drivers ng changes ng fair value of financial instruments. And as you can see, the biggest portion, ito. Ito usually, maliit lang yan. The profit margin can be usually negligible na yan. Credit risk premium pertains to credit risk. Ito yung binabante mo for ECL purposes. Pero pagdating mo sa marking to market or fair value changes, ito yung talaga yung nagda-drive. Yan yung nagbabago every day. And that is where the fluctuation of fair value risk or cash flow risk comes up. And yan yung subject ng hedge accounting. Hedge accounting is actually a result of management's financial risk management decisions rather. It's if the management decided let's hedge or manage a risk with our exposure to a floating rate instrument by fixing the interest rate component, hedge accounting should reflect that decision. As mentioned, hedge accounting is an exception to the classification and measurement rules, which we will highlight later. And hedge accounting is actually a privilege. It requires the entity that is using hedge accounting to continuously comply with its requirements. If it fails, then that privilege is taken out. What are those requirements? Relevance and qualification, meaning once a decision is made, that decision should remain relevant and the situation still is applicable to the company. Documentation, the company must be able to retain documentation of approval and other requirements. Finally, periodic testing for effectiveness, meaning when you take a strategy of managing your risk and capturing it, there must be a mechanism in place to make sure that your strategy remains effective qualitatively and more so quantitatively. Bakit sword yung symbol ko ng hedge accounting? Hedging is a double-edged sword, as Professor Dayag of accounting would say. It's a double-edged sword in the sense that once you make a decision to hedge your risk, meaning to protect yourself from the downside of that particular risk or protect yourself from losses, potential losses from that risk, you also eliminate any potential upside or benefit from being exposed to that risk. Kaya double-edged. But there is a reason why you're doing that, and I'll explain in a short while. Okay. So, kanina po tinuro ko sa inyo, fair value risk tsaka cash flow risk. Yun yung dalawang main market risk that we're going to focus on. Pag may fair value risk ka, you do a fair value hedge. So, let's say the company has an investment in debt securities or bonds with a manufacturing company, fixed rate. So the company, to manage its exposure to fair value risk, remember about fixed rate, nagbabago-bago ang fair value niyan. They can enter into a derivative transaction with a bank, giving away the fixed component of that bond in exchange for receiving a floating component via an interest rate swap. Swap meaning palit tayo. Bigyan kita ng fixed cash flow at 5%. bigyan mo ko ng repricing every year for the next X number of years. So, kinonvert mo from fixed yung bond into a floating bond. So, kanina yung illustration, di ba? Ito yung risk ko kanina. Because of the derivatives, the interest rate swap, is in substance, ito na ako ngayon. From fair value risk, na-eliminate ko yung fair value risk, but remember, double-edged sword, naging cash flow risk naman siya. Ay, sorry. Cash flow hedge naman intends to manage your cash flow risk. Suppose the company has a floating rate debt. May utang siya, tapos nagre-reprice yung utang niya. And it is afraid that the interest rates would go up. Their cash flow coupon interest payments would likewise go up. They can enter into a derivative transaction asking the counterparty to fix or to give you the floating rate part and fix the cash flow component. So again, an interest rate swap. This time, pabaliktad. Float to fix. Kanina, fix to float. Ito, float to fix. What would happen now is, ito kanina, may floating component ka. Because of the derivative transaction, ito na ngayon ang itsura mo. Pabaliktad. No? Market risk would always be there, but the profile could change depending on the structuring that you will do. In this particular transaction, this is the hedged item, while the derivative contracts are your hedging instrument. So far, so good. No? Sabi natin, may exposure ako sa risk, either cash flow risk or fair value risk. Pag fair value risk ang exposure ko, gusto kong i-manage or i-mitigate yung cash flow risk ko, fair value risk ko, enter into a fair value hedge by converting your floating rate, your fixed rate instrument into floating rate. Kapag cash flow risk naman, because you have a floating rate instrument exposure, you can manage that risk by converting the floating component into fixed via a cash flow hedge. Okay. Naalala niyo po sa classification and measurement, ang derivatives always fails the SPPI test. Kasi wala namang principal, solely payments of principal and interest sa terms nun. So, under classification and measurement, general rules, derivatives are always at FVPL. And may problem tayo pag ganun. Bakit? Anong problem yan? Kasi what if yung FVPL mo, ito yung derivative, di ba? Yan yung derivative. Itong FVOCI mo, yan yung bond. So may mismatch. Saan galing, nasan yung mismatch? Yung fair value changes ng derivative, nandito sa P&L. Pero yung fair value changes ng bond, nasa equity. So, when you prepare the financial statements, nandito yung isa, nandito yung isa. Ang hedge accounting, hedge, you're supposed to make the two variables meet. Kasi the negative in one side will offset the positive of the other side. Thus, neutralizing the two. Hedge nga pambangga mo yan. But in this case, kahiwalay sila. Ganyan sa fair value hedge. Sa cash flow hedge, mas malala. Bakit? Kasi ito na yung utang mo nandito. Yung derivatives mo nandito. Yung fair value changes ng derivative mo nasa P&L. Yung cash flow mo, saan kailan mo siya mararamdaman? Only when you reprice, which is in the future. Wala pa. Diba? Dito, kahit paano, pag nagsara ka ng P&L, puntang equity. Yung kabilang yung cash flow hedge, wala. One-sided. You will only feel the impact of the bond kapag nagre-price. Sa future pa magre-reprice. Yeah. So because under normal classification and measurement rules, may mismatch ka na. The goal of hedge accounting is to neutralize not just the risk and the volatility from the books, but even the accounting mismatch. And under hedge accounting, sa fair value hedge, kung ganyan ang itsura ng balance sheet mo, exception to the rule. Sige, FVPL yung derivative mo ha, pero yung fair value changes mo na kay equity. Kasi exception to the classification and measurement rule siya. Once the hedged item fair value change reaches P&L, susunod naman yung derivative. Magkasama sila. They would always neutralize each other, whether they're in the balance sheet or in the income statement. That's the point of hedge accounting. Ganon din po pag cash flow hedge. Since wala pa yung effect ng cash flow risk mo, dahil sa future mo pa siya maramdaman, nakatago sa equity yung fair value change ng derivatives. Baon mo yan. Clean, malinis yung P&L mo. Kasi wala pa yung interest expense. But the moment you reprice and you now reflect that repriced portion in the P&L, lalabas na yung fair value change. Punta ng P&L. Again, match sila. Yan ang purpose ng hedge accounting. To always, to reflect the risk management decision in the financial statements. Remember, kaya ako pumasok sa ganitong ka-complicated na transaction is to neutralize either the fair value risk or the cash flow risk. And that effect is not just for economic reasons, but even for accounting purposes. However, if we follow only the classification and measurement rules, there would be mismatches. Hence, hedge accounting is an exception to the rule wherein certain default requirements such as fair value changes being reported in P&L are circumvented or temporarily suspended to reflect the risk management decision made by the company. Yan. Kaya medyo masakit sa ulo yung hedge accounting. Masakit na nga sa ulo yung derivatives. Hirap nang intindihin na classification and measurement. Tapos, ganyan pang hedge accounting. So, it's really, in practice, so some companies do observe this, not just banks, especially if the risk that they're trying to manage are material vis-a-vis their operations. There's a third type of hedge. Net investment hedge ang tawag. This is usually when there is a company, let's say based in the Philippines, they have different subsidiaries and one of their subsidiaries is exposed to foreign currency that is not the functional currency of the company. Therefore, exposed siya sa translation. But since this is an investment in a subsidiary or associate, iba yung accounting. Ang hedged item mo dyan would be yung exposed to foreign currency. Under normal or non-hedge accounting rules, ganyan na itsura ng investment mo, and you have a cumulative translation adjustment component being reported in equity. Tapos, meron kang mga potentially, meron kang dollar assets and that those dollar assets gets retranslated or translated into peso at the prevailing dollar rate. Those translation FX gains or losses are reported in P&L. So, may mismatch ka. Meron kang volatility dito, tapos may volatility ka rin dito. Under hedge accounting, pwede mong pag-matchin yan. Pag ganyan itsura ng investment mo, because of hedge accounting, the FX that is usually in the P&L can now be presented under equity. And then once you dispose of the hedge item asset, that's the only time you release the P&L component of the hedging instrument. So, yun. The key lesson here is that under hedge accounting, the rules of classification and measurement are modified in favor of reflecting the true intentions, or the intentions rather, of risk management decisions, particularly on matching the risk effects of the hedged item with the hedging instrument. Without hedge accounting, if you use derivatives, which are usually at fair value through profit and loss, tapos yung hedge item, they are not at fair value through profit and loss, then there would always be an accounting mismatch. The hedge accounting rules, once you comply with its requirements, allow you to reflect in your records, in your financial statements compliant with IFRS, those neutralization decisions or risk management decisions.